Since the introduction of Section 4 in 2017, many property investors have had the dilemma of whether they should continue buying property in their personal name or make the switch and start buying property in companies. However, the thing is, it's really not that simple. In this video, I want to break down the key factors that you need to be aware of before you make that decision. If you're watching my videos for the first time, my name is Saj Hussain, and on this channel, I share with you my 15 plus years of property investing experience to ultimately help you get further faster in your own property investing journey. Section 24 was introduced in 2017 and gradually rolled out to have its full effect by 2021. Essentially, over the 4 years, with 25% coming into effect each year. In essence, what it means is that property investors, we now get taxed on turnover as opposed to being taxed on profits, which is how the vast majority of businesses are taxed. I know what you might be thinking right now. Hey, that's massively unfair. And I completely agree with you, but hey, let's not shoot the messenger. What I want to do in this video is just explain how it works. However, this really affects the higher tax bracket people, so for those paying 40% or more, because there's a 20% relief available. So those that are only paying 20% tax, they've got 20% relief, so not really having a big effect on them. But those that are paying 40% tax, for example, they get a 20% relief, so they're paying 20% more. Let me explain by way of an example. Let's say you've got a property that generates you £15,000 a year rental income, and then you've got a mortgage that you pay. Over a year, you pay £5,000 in interest. That means you're left with £10,000 profit. In any ordinary business, and even in property, prior to Section 24, that means you'd have had to pay tax on that £10,000. So if you're a lower rate taxpayer, that's £2,000, and if you're a higher rate taxpayer, that would have been £4,000. However, Section 24 means you can no longer offset all that interest. So rather than paying tax on the £10,000, now the tax is calculated on the £15,000, i.e. the total amount of rent that's being collected. So for example, that means somebody that's on a 20% tax bracket, they will now be paying £3,000 of tax, and somebody in a 40% tax bracket would be paying £6,000 in tax. You can then claim back 20% of the interest that you've paid. So in this example, we paid £5,000 in interest. 20% of that will be £1,000 that you can claim back. That means the person in the lower tax bracket, i.e. paying 20%, previously, before Section 24, would have paid £2,000 of tax. And in this example, they're still paying £2,000 of tax because the relief applies. So no real difference to them. However, if they're in the higher tax bracket, that 20% relief, i.e. £1,000, that would reduce their tax bill now down to £5,000. But it's still more than what it would have been prior to Section 24. Now let's look at the same example if the property is in a limited company. So you've got £15,000 of rent being collected, £5,000 being paid towards mortgage interest, and there's £10,000 of profit. So in a company with taxed as corporation tax, which currently is 19%, which is likely to increase soon. However, based on the current rate of 19%, that means they'll be paying £1,900 corporation tax on the profit of that particular property. Now, this is still less than paying tax in your personal name, either as a lower or higher rate taxpayer. You might be thinking right now, yippee, let's go and buy property in limited companies. However, there's a few other things still to consider. So when the property that's in the limited company is making a profit, that profit belongs to the company. You may own the company, but the profit belongs to the company. So extracting that profit and utilizing it for your personal use, there's still other hoops that you need to jump through as well. And one of the challenges is double tax. So what that means is you paid the corporation tax, you made the profit that you've got in the company, but when you're taking that profit out, you're either paying yourself dividends or you're paying yourself a salary. Now you're getting taxed on the dividends and the salary as well. Then you've got to take into consideration the cost of setting up a PAYE scheme, the administration side of running a company as well. The accounting fees will be higher than just running your portfolio in your personal name. These are all factors that need to be considered because they will impact how much net money you actually end up in your pocket. Another factor to consider is the mortgage interest rates that you'll be paying within a company are often higher than that in your personal name. Now that gap has been reducing over time quite significantly. However, the rates still appear to be higher for mortgages in company names than they are in personal names. Let's now flip it the other way around and look at some of the advantages of having the property in your company name, other than just the taxation benefit we've spoken about. Well, one of the things is the longevity of the company. At the end of the day, we're only on this earth for a limited period of time. I'm sorry to remind you about that, but there's a time that our life will come to an end. However, a company's life can continue and live beyond its original owners. So there can be other people can pick it up and continue to run it. So if you've got family members, for example, you want to get involved in the business, they could be the shareholders. So the succession planning is much easier when going through a company than it is with property in your personal name. Essentially, from an inheritance tax point of view, it'll be more efficient to transfer those shares to somebody else than it would be to transfer property to somebody else. If you are doing property on a more serious level and you're planning to build this as a bigger business and maybe multiple different companies doing different types of property activity, then there's some real advantages in having property within companies, particularly when you set it up as a company group structure. So one of the other things, for example, that's a benefit by having the property in a company name is whenever, let's say, your toilet gets blocked by your tenants and you're rushing out there trying to unblock the toilet, not that I'd recommend you do that, but let's say that's what you're doing, you're going to go and do those minor repairs yourself, you can't charge yourself for the cost of doing that. However, when you've got a company, it's a separate legal entity, so you can charge for your time that you might be using to go out and carry out those repairs. Now, really, you're charging yourself, but what you have is control over where you are building profits or where you're incurring those costs as well. So you have much more flexibility. In essence, if you're a 20% tax rate payer and you keep property in your personal name and you have that as your primary income, i.e. you don't really have any other income, if you've got 2, maybe 3 properties, you're probably going to be okay by keeping those in your personal name. However, if you're a high rate taxpayer, if you've got a significant number of properties, then it makes much more sense to have these properties in a company. However, the key thing is there's so many things that need to be considered within someone's personal circumstances before they make some proper tax planning, that it's so important that you're getting the advice from a competent tax accountant. Now, if you need some help in that area, we've got some great people that we work with that are fantastic at tax when it comes to property, then reach out to us and we'll try and connect you with somebody that can certainly help. If you found this content useful, then I'd really appreciate it if you click on my face over here to subscribe to the channel. It's absolutely free. And then what to do is watch this video over here, which I've got lined up for you, which will help you understand where the real opportunities exist this year in property investing.